Everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha, and known by many of you as Mr. Valuation. You know, primarily I've been focusing in recent videos and my career here in the later stages in my 50th year of doing this, I've been focusing more on dividend growth stocks. But I've had some interesting questions posed to me, and I thought it'd be fun to kind of play around with this. And the question was, will Amazon ever pay a dividend? It's one question. The second question is, would an investment in Amazon even be appropriate for investors that are dividend income or dividend growth investors? And, you know, I'm going to propose here that the answer to those questions might all be yes. You know, I do think Amazon will eventually pay a dividend someday. Number two is I do believe that Amazon, a growth stock as powerful as Amazon is appropriate probably for everybody's portfolio, at least for some small portion or even a larger portion of your portfolio, depending on how much money you have. But then I'm also going to talk about some interesting factors here regarding powerful growth stocks eventually morphing in to dividend growth stocks in the second place. So let's have a little fun here with the amazing Amazon and what might happen. Now, those of you who don't know, Jeff Bezos announced his retirement in February of this year. He's still going to be involved in the company and a lot of aspects of the company, but he's turning over the day-to-day aspects. By the way, he has his longstanding partner, Jeff Wilke, is also retiring, and he's the number 2 guy at Amazon, and he's got over 48,000 shares of Amazon worth about $158 billion. Not too bad. Jeff is worth about $218 billion, according to reports as of yesterday's close. And, they claim that if Jeff would have never given up any of his shares, like to his buddy there, Jeff, his other buddy, Jeff, then, his net worth today would be over $485 billion. Boy, that's a lot of money to give away, isn't it? But anyway, nevertheless, the point is there's an enormous amount of wealth here. Now, Jeff is retiring, his number 2 guy is retiring, and the company has gotten very, very big. As you can see, it's got a market cap of $1,749 billion. That number is hard to even say, let alone read. But of course, the company is AA- rated, has 43% long-term debt to capital. And the company has always been really focusing on generating cash flow and reinvesting their money. And I'm going to talk more about that a little bit later in this video. But the real key is when you look at how this company has performed as an operating business, operating cash flow has really been the story. And it was even announced in the first annual letter that he sent to his shareholders on his first annual report in 1998 or the 1997 report, where he said, we're not going to worry if it comes to making a choice between profits and cash, we're going to go with cash flow. And he's lived true to that, and the market has listened to that, apparently, as you can see by this graph here. So let me make sure you're clear on what I'm showing you here. This is operating cash flow per share, and I only go back to 2004. So in 2004, the company generated $1.33 per share in operating cash flow. That increased to $1.72. They had kind of a weak year. During the recession, their cash flow growth just exploded by 100% and 19%, followed by 90% even in 2009. So they did, there was obviously not much in the way of a recession bothering the company. But over time, you can see that they've grown their cash flow steadily. Now, there's no dividends on this graph, clearly, because the company doesn't pay a dividend. So the bottom line is it's been all about price. Now, historically, the market has valued this company at about 25 times operating cash flow. 25.67 is the number. Now these numbers are dynamic. I want to make that clear. If I change this, since 2009, they've been valuing the company at about 24 times cash flow. It's currently trading at about 25.9, or we'll call it 26 times cash flow. So, that gets a little dynamic, but that's market value. But now when I shorten the time frame again, I'm back up to 25.7 times cash flow. The point is, when you're dealing with very fast growth stocks like that, the first thing is I'm using the P equals growth rate, but in this case, the price to operating cash flow equal to the company's growth rate. So, the company's grown cash at 32% since 2014. So I'm using the price to operating cash flow line here at 32. I lengthened the graph, and the growth rate has been 30 times earnings. So now here I'm using a 30 times operating cash flow and a 24. The point is, these numbers are always ish, but I just want you to see and take note here that obviously where this company's growth has gone, that's where their stock price has gone. Now, the performance with no dividends has been absolutely extraordinary. And I'm going to go ahead and expand this out to the full measure that I can here. So had you put $10,000 in Amazon on December 29th, 2000, you'd have bought shares at $15.56. Yesterday, the shares closed $3,471 a share. That would have turned $10,000 into $2,230,559. Even if you'd have waited 4 or 5 years after that, you'd have still turned $10,000 into $676,000. And even if you'd have waited a few more years, you'd have turned $10,000 into $138,000. The key is, look at these annualized rates of return with no dividend, 37% per annum since 2012. I go, all the way back as far as 20 years, we've averaged 27% annually. I do 11 years, we've averaged 37% annually. This is obviously an awesome company. But, and it's clearly a growth stock. There's just absolutely no question about that. Amazon is a growth stock. But, what about growth stocks? What happens to growth stocks? Well, historically, very fast-growing companies inevitably run into the law of large numbers, which simply means that when they're young and scrappy and growing like weeds, like Amazon has, at least from a cash flow point of view, and a revenue point of view, by the way, what happens is the companies tend to reinvest a lot into their business. And again, Bezos made that very clear that that was his goal. Okay, but what happens is the bigger they get, the more difficult it is to find investments that can either move the needle or give them, the rates or the returns on invested capital that literally justify them doing that. So what begins to happen is these big companies, these fast-growing behemoths, once they become behemoths, start to pay dividends. So let me show you a couple of examples here just to illustrate how this happens. This is Amgen, which is a very large biotech company. At one time, the largest. I think it might still be, but I'm not sure. But anyway, bottom line is, forget about the price on this graph. I'm going to take the price off of the graph so you can see what I really am trying to point out here. The company was growing very fast during these, coming in even past the Great Recession. And then all of a sudden, the growth rate started to slow a little bit, okay? And they really started to slow, in more recent years. And so what happened was, they began paying a dividend in 2011, okay? And their payout ratio was only 10% that first year. Then the second year it went to 22%, then 24%. Last year they paid, or in 2020 they paid 38%. And they're expected to pay around 43% of their earnings in dividends this next coming year. Now, what that means is this. If I look at this company from a long-term perspective, going all the way back to 2000, the capital appreciation was about 6.6%. But what I really want you to focus on is the dividend and the dividend growth rate. Their first dividend in 2011, and let's go ahead and look at that. Let's knock this, chart down. As you were coming into 2011, let's say from, 2010, your first year's dividend yield would have been approximately 1%. But this is called yield on cost, or I like to call it growth yield. But, the first dividend increase went from 56 cents to $1.44. You'll see other examples of that here in a minute. So we've had this huge dividend growth. Now, the growth rate is beginning to slow down. Historically, though, Amgen has grown their dividend at 31% compound annual growth rate and 36% average growth rate over the 9 years that they've paid a dividend. That's really extraordinary. But what happens here, the main point I want to make is I'm going to go into the forecasting calculators here of fast growth. I'm going to go into the historical compound growth rate, and I'm going to go to this drop down here, and I want to make a point. What's happening is these companies, the long-term growth rate was 15%, but then you can see more recently the growth rates have been 6 and 7%. As these companies get big, their growth rates begin to slow down. So let's take a look at AVGO. AVGO symbol, Broadcom, is the name of the company, obviously, and it's had a very, very strong growth at over 37% a year. It started paying a dividend as well in 2011. So once again, if we go and look at the dividend growth rate has been extraordinary, and it's been remaining that way, by the way, all along. So they've had an average dividend growth rate of 51%, a compound average growth rate of 49%, and once again, you start out with a relatively low yield, but that yield just balloons. And look how much more income this produced even than the S&P 500 by virtue of the fact that its dividend is growing so fast. But again, when I go into forecasting and go into the historical compound annual growth tab and look at growth, 12 years ago it was growing at 44%. But then look how that growth has slowed down. And actually the last couple of years, it's really been slowed down. So what happens is, as the growth of these companies begin to slow down, you can see that growth rate slowing down as I change the time frame. The dividend then becomes the main attraction for these companies. So it's very, very common for, premier growth stocks to inevitably start paying a dividend and then to grow that dividend very fast. Here's the Intercontental Exchange, which is a very interesting stock exchange, or exchange, if you will. They're also regulated exchanges, clearing houses, and listings for commodities, fixed income, equity markets, etc. So it's a very fast-growing company. It's been growing at over 34% a year since they went public in 2005. As you can see, they've grown very fast. They've, traded at about 25 times earnings historically. They didn't start paying a dividend, however, until 2013. And once again, we see this, recurring pattern. Their first dividend was 13 cents, but then they increased it dramatically to 50 cents. So when we look at performance, this company generated very strong historical performance over the, short time frame that it's been an operating company. But look at their dividend. Their dividend started in 2013. I'm going back to 2005 here, where I generated $180,000 of capital growth. 10,000 turned into 182,000. But the company also would have thrown off over 9,000 in dividends. And even though they didn't pay dividends the whole time, and the S&P 500 did, if you will, they dwarfed the S&P 500 in income. But again, look at the dividend growth rate, 55.7% on average, 37.4 compound average dividend growth rate. But once again now, when I go into and look at their historical growth, it was 30 and 40%, in the beginning, and it slowed down into the teens, and it's been hovering around the teens now, expected to slow down to about 9% going forward. So as big companies begin to slow down, once they start hitting these, huge numbers, they start paying out more of their earnings in dividends. In 2016, they paid out 24%. Then it went to 28%, expected to be about the same this year. So what happens is these companies that were very, incredible growth stories and growth stocks all of a sudden become very powerful dividend growth stocks. Their dividend yields are not always, current dividend yields are not always so great when they start out, but they tend to grow their dividends very, very quickly. Even the formidable Apple, which has been a tremendous growth story. We know that. And I'm not talking about the price, guys. I believe that Apple's overvalued. I'm going to get a lot of flack for that. Bottom line is Apple's a great company, one of my favorite stocks in the world. They just had a great earnings announcement, but none of that justifies this high valuation of my point. But even Apple, with a $2.24 billion market cap, has become so big it's becoming more difficult for them to grow. So forecast growth is expected to slow down to about 10 or 11% a year. The trend line growth rate is about 14% a year, so somewhere between 10 and we'll call it 14 or 15% a year, which is absolutely incredible, but it does not justify a 37 plus multiple, in my opinion, with an earnings yield of only 2.66%. But that's not really the message I'm trying to get across here with this video. The message is that even the formidable Apple, was a very, very fast-growing company whose growth rate, as you can see, these are historical growth rates with no estimates contaminating them, has, slowed down quite a bit. So that's normal. They hit the law of large numbers, and then they start paying a dividend because they don't have anywhere to put all the formidable, cash flow that they're generating any longer. And then finally, Cisco. Cisco was a classic, prior to the Great Recession and even prior to the tech bubble. If I could go back another 10 or 15 years, this was a phenomenal growth story. It had huge, growth, 25, 35% per annum. But then that growth began to slow down. As I shortened the time frame, it starts to become a single-digit grower. They started paying their first dividend in 2011, but once again, the dividend growth rate was extraordinary, over 38% a year. So if you're looking for, if you've got a lot of time for retirement, or even if you've got excess cash where you've getting enough income off of your portfolio, putting some growth stocks that are getting real big, especially like Amazon, and of course like Cisco and Amgen, all the rest I showed you here, could be a phenomenal place to go ahead and put money. And I believe there's room in everybody's portfolio for that. But I also want to talk a little bit more about Amazon and go through some of the fundamental numbers here of this, really awesome company. So I'm going to turn to fund graphs, the financial underlying numbers, and I'm going to go into the millions graph. And I want to start out by looking at revenues, or sales, if you will. This has been an awesome company. They've grown revenues at over 28.9%, and I'm going back here till December of 2001. And you can see their revenue growth has been absolutely consistent. Now, I also want to make another point. When I look at, operating earnings, if you will, or if I look at operating earnings or net income, I do want you to notice that the company has a relatively shaky period. I'm going to use the line graph here just to clear that they haven't had as consistent amount of operating earnings. Again, that goes back to the fact that, the chairman there said, it's all about cash flow. It's all about generating, consistent cash flow growth. And as I showed you earlier, this is another way to look at it. You can see their cash flow growth has been absolutely extraordinary over the years, and has grown at a extremely fast rate. I'm going to shorten the time frame here a little bit and try to get a calculation here. Since 2003, cash flow has been growing at over 35% a year. That's absolutely enormous. But also free cash flow has been very important. And the reason I bring that up is if this company now decides to start paying a dividend, if they pay just, half of their free cash flow, not their operating cash flow, the potential dividend income can be huge. And Bezos has indicated, at least the rumor is that he's indicated that he will eventually, retire fully and live off of a very small portion of the dividend income that he can get off of Amazon stock and then give the rest to charity. So, the reality of it is that he's probably looking at declaring a dividend at some point in time. And the company, with the other Jeff also retiring, and the company now is, changing hands a little bit, I could see it morphing into a more traditional, dividend paying, high quality blue chip dividend growth stock going forward. I can't promise you that's going to happen. It may never happen, but I doubt that. But anyway, that's something to look at. But let's look at how profitability is going. That's something I also find very fascinating about this company. So here we got total revenues. Now let's go ahead and look at cost of goods sold. Okay, and what we're expressing here is net margin. And what I want you to see here is the net margin, gross margin has actually been increasing quite a bit. Now I can look at that another way. I can look at the company from a standpoint of just pure gross margin. And you can see that, I'm going back only about 9 years here. Their gross margins have increased dramatically. If I look at net margin, their net margin is also doing real well. And it's gotten stronger and stronger in more recent years than it was historically. There were times when they actually had negative net margin. Again, that was the nature of the beast. Bezos, had many years where he had negative margins, where he was actually losing money, if you will, because it wasn't what he was going after. But now if we look at the stock here more recently, we're starting to see over the last 10 years or so, and I'll even shorten it some more, that things like returns on assets are increasing dramatically. Returns on equity as well are increasing dramatically. Returns on invested capital are increasing dramatically. So all in all, this company is becoming a much more profitable company. And the last thing I want to do here is I'm going to get price out of the equation, because this company is not justifying its current value based on operating earnings at this stage. That's one of the points I'm trying to make clear. But what I do want you to see here is that operating earnings are beginning to grow and grow dramatically based on all that improvement in profitability that we just saw. So, we're starting to look at some really incredible potential growth. And then so if I do put price in more recently, operating earnings growth as the company's margins and so on are improving dramatically, are starting to justify, this company's valuation. But it's still, highly valued based on operating earnings growth, and forecast earnings growth is expected to be extremely strong, but yet not necessarily justifying a 77 PE based on operating earnings growth. And by the way, people always like to talk, but let's look at GAAP earnings as well here, with this company, because, people are always saying I'm, picking the wrong metrics. See, Amazon has been growing organically by reinvesting their capital. And so their diluted earnings growth has also been very, very attractive. And of course, I've been showing you cash flow and things like EBITDA, which is, pre-tax cash flow, earnings before interest, taxes, and depreciation, if you will, has been very stellar. And the company looks very attractive based on EBITDA from a valuation point of view. So this is a very interesting stock. It's a growth stock, pure and simple, AA rated, very high quality, one of the most phenomenal stories, and of growth that we've probably ever seen in recorded history. Their founder, Jeff, is, the richest man in the world. I think, what did I tell you, $218 billion, net worth as of yesterday's close. He could start having Amazon pay just a very insignificant little dividend, and he'd be generating more cash, certainly, than any human being could ever spend. But this is an interesting stock to include in your portfolio. I do believe you look at it a little differently than you do most stocks, but the real key here is that, as it has happened in the past, big, fast-growing companies eventually, start to pay a dividend at some point in time. Even the mighty Microsoft, which, everybody talks about, and I still talk about the fact that it's overvalued. This isn't about valuation like I normally talk about. This is about dividends and dividend growth. And what I really want you to focus on is the dividend growth. Microsoft has been a phenomenal generator of dividend growth. Their first dividend in 2003, would have started out with a 0.4% yield, virtually nothing. But by last year, they would have been yielding over 9%. And their first, payout ratio was less than 10%. And their payout ratio has steadily increased up to about 35%, but that there's still a lot of room for the dividend to grow. So although I don't like buying Microsoft here, buying Microsoft somewhere back here when the stock was very inexpensive would have been, forget the price performance, the dividend growth alone would have been, worth spending the money. So it's not uncommon for these big, fast-growing stocks, when they get real big, to start paying a dividend. Hope you enjoyed this video. Hope it gave you some more insight into not only Amazon, but dividend growth stocks as well. It's been Chuck Carwell saying thanks for watching. Ring the bell, give me a thumbs up, subscribe to the channel, do all those things that, I always appreciate you doing for me. And I look forward to talking to you again real soon.